So, is the economy getting worse or is it recovering? The stock markets just fell by around 5%, despite great recent economic news in the US, which in our view has gone underappreciated. In the last couple of weeks, the US released their latest jobs report, which showed an economy with far better than expected fundamentals. High prices had left investors wondering if the US bubble was about to pop, but this new information forced investors to look again at America's strengths.
Then, this jobs report was somewhat contradicted by the Fed, who said they wouldn't be raising interest rates for the next 18 months, which investors took as a sign that the recovery will be slower than hoped. The markets are temperamental right now, and the boost from the economic report on jobs was in our view based on more substantial foundations than speculation about interest rises from the Fed.
The initial boost to stock prices was particularly felt in the US, which pushed the S&P 500 back to roughly where it was before the crisis, and the Nasdaq 100 to about 10% higher to its all-time record high. An all-time high in what is supposed to be a major recession. While there have been stock market jitters in the last couple of days since the interest rate speculation, just looking at the economic data alone, you might be forgiven for asking, what virus?
So what just happened to cause the previous week's spike? The jobs report showed US unemployment falling to 16.3% in May. A month earlier in April, it was much higher at 19.7%. According to the report, the US economy actually added a net 2.5 million jobs in May. In layman's terms, jobs are being created, not lost.
There's a saying that the stock market is not the economy. It certainly isn't. The economy is supposedly on its ass, while the stock market is still near all-time highs. But now, for the first time, we're seeing economic signs which suggest that the worries about the financial impact of coronavirus might have been overblown.
Can the jobs report and its implications for our portfolios be trusted? Are the markets now panicking unnecessarily when they should be celebrating? Let's check it out.
Welcome to moneyunshackled.com, the investment channel and website that sets you and your finances free.
I'm Andy and that was Ben. And if you like what we say, hit the like button and click subscribe. If you want to take advantage of the stock market in these turbulent times, opening an account on the free trading app Freetrade will bag you a free share worth up to £200 when you sign up using the link on the office page at moneyunshackled.com. The link to the office page is in the description below. Now let's get into the video.
What is this jobs report? The US Bureau of Labour Statistics release monthly updates on the state of unemployment in the US. These tedious documents, widely ignored by everyone with a life during normal times, have become a point of interest in the current economic crisis.
The way that reports like this can impact you as an investor is when the results differ from the pre-release predictions. Consensus expectations for May were that the unemployment rate would rise further with another net 9 million people becoming unemployed. What actually happened was it fell by a net 2.5 million people. In other words, the US market got a bit of good economic news to the tune of 11.5 million more people employed than it expected, and renewed confidence in the US led to a stock price surge.
It answers a few questions. We've been watching the US stock markets climb now for several weeks, with most people expecting a crash just around the corner. We'd love a crash as it's a better buying opportunity, but this report changes the likelihood of there being one. And we're not talking about a mere 5% fall. For market watchers, it's a fundamental shift in the facts that allows investors to look at the prolonged US stock boom with more confidence than before.
Many of us have struggled to reconcile the strong stock market position with the economic reality of the last few weeks. The report helps to address these questions, seemingly showing that the economy is beginning to catch up with the stock market. It is usually the case that stock markets move ahead of economies.
It looks like Americans are headed back to work in large numbers as the US economy reopens. Maybe stocks will just keep climbing slowly out of this crisis, in which case we'd want to continue investing during the climb. A few more reports like this and thoughts of a crash would go out of the window.
The Fed doesn't think it's enough. The US Federal Reserve, who sets US national interest rates, have said that they don't plan on raising interest rates until at least 2022. In this, they are taking a much more pessimistic approach to the recovery. The markets took this as a grave sign that the economy would take forever to recover, as raising interest rates is something you can only really do when economies are strong. This is why stock prices just fell by around 5% just now, as panic ensued.
However, the Fed also agreed that unemployment is falling and will fall to around just 9% by by the year end. Remember, we're currently on 16.3%, down from 19.7% in April. The economic outlook is actually still rather better than hoped, and it seems that markets can succumb to short-term memory loss once mass panic sets in.
How can the economy be doing so well? Let's look at what's behind the data to see if it translates into anything concrete.
Number 1, the Payroll Protection Plan. The US's COVID bailout scheme. 2.2 trillion of bailout cash to help employers rehire employees that had been laid off in April. It might be that the scheme is working to stabilise the economy better than initially hoped, but surely at some point the money will run out.
Number 2, hospitality resuming. A big chunk of those going back to work are 1.4 million people employed in food services and drinking places. We've seen with businesses like McDonald's opening their drive-thrus that the hospitality industry can continue more or less as before if given a few weeks to figure out how to adapt.
Businesses want to continue trading, and many are finding ways to keep staff on the books by operating as best they can. Of course, it could all be short-termism derived from the US's bailout scheme.
Number 3. America is too big to fail. It could be that the US economy is just a lot more resilient than everyone thought it could ever be. We know that the 2009 financial crisis destroyed the US economy, but that was because the lifeblood of the economy, credit, was removed by the banks following their years of malpractice.
In 2020, everyone wants to spend, compared to 2009, where everyone wanted to hoard. America's finances are so strong that it can weather a storm for longer than most other countries. That government injection of cash is obviously helping, and as long as the lockdown continues to be eased and there is no second spike of the virus, the US economy just might keep on slowly waking from its coma.
If it's an anomaly, since that miracle jobs report, it's looking more unlikely that the market will significantly crash again. And here we mean by a significant amount of 20% plus. But this data could just be an anomaly. If there is a crash, we'd want to be stood there on the sidelines with cash waiting in our investment platforms ready to jump in. It would be a fantastic opportunity to buy big and buy cheap.
Whereas, if the report is reflective of wider economic recovery, we'd want to have been drip feeding money into that recovery, which means little and often right now. We all wait with bated breath for the Q2 gross domestic product report in July to find out more definitively how badly or not the US economy has been handling coronavirus. But here's why we suspect the US will be okay.
The US's underlying strengths. The US stock market is packed full of technology companies and major industries such as healthcare and consumer staples that are poised to do very well out of a virus-based crisis.
We look at the tech companies like Microsoft, Apple, Amazon, Facebook, Google and Netflix who love that there's a lockdown on, and the healthcare giants Johnson & Johnson, Pfizer, United Health, Merck and Amgen who stand to benefit from sales of new drugs and equipment.
And it comes down to this: what are you investing in? Is it the US economy or its stock market? Good economic news obviously helps stock prices, but the giant companies of the S&P 500 and the Nasdaq are quite different to a corner shop selling chili dogs in North Carolina. The big tech and healthcare giants of the US can survive and prosper regardless of what is going on in the country at large.
Question of the day: is the economy recovering or is it getting worse? Will you be investing regardless of whether there's a crash or a recovery? Let us know in the comments below.
Thanks for watching! On this channel we talk about personal finance, investing and all things money, and if you want to see more great content, please click the subscribe button below.
This is moneyunshackled.com. See you next time.